Good evening, everyone. Thank you for being here. I would like to, start with an introduction. So, here we have today Saurav, who is the founder of Jiraaf, and my name is Parth. I'm part of the founder's office. Let's get going. Let's start by thinking about how we manage our personal finance, right? We typically we manage money by investing in maybe FDs, or we look at investing in maybe equities. But we all know with FDs, your returns are a little less, though they are safer. And when it comes to equities, your risk is higher, return is higher. But how do you typically manage safety and returns? I think that's where bond comes into my mind. And if you could just, help us understand what exactly bonds are, that would be great.
I think before we get to what bonds are and we'll talk about it, I think in general, I think there's a larger question that you asked, that how should people think about their own money, right? And how do we actually think about managing a financial portfolio? So everyone has certain corpus that is available with them. How should they think about which are the asset classes that they should invest in? And the second is, at what stage of their financial journey which asset class is right for them. So I think before we begin this, in general, this is a more personal finance discussion. But I'd like to just highlight that the way people think about money first is that there is no asset class which is, I would say, great, and there is no asset class which is bad. I think every asset class has its own place in a financial portfolio. And today we learn about why we feel bond is such a powerful asset class in one person's portfolio. And just from the way to think about managing wealth or managing money is, I think in a financial journey, you will have many things which are non-negotiable and then many things which are discretionary. I think the first point is for people to think of, first make sure that you have an emergency fund available, whether that is, 3 months, 6 months salary or expense, or let's say 1 year. So set aside some money for your emergency fund. Do you have all your insurances in place, medical term insurance? And once you're done with an emergency fund and an insurance, then, you basically have capital available at your disposal to start thinking about investments. And when you start thinking about investments, that's where you can then think whether fixed deposit, equity, bond, what is the right asset class is for you. A lot of the, I would say, the answer lies in what you are trying to achieve with your money. So, like for example, in general, if your goals are like more 5-10 year oriented, equity may be the right asset class. For goals that are more short term oriented, I would say bonds might be the right asset class. And then obviously, where you need immediate liquidity, for example, your emergency fund and so on and so forth, maybe fixed deposit is the right asset class. So I think the right asset class is an outcome of what you try to achieve with your money. But I think the first and foremost is to get basics right, set that emergency fund, have your insurance in, then start thinking about investments. So with that backdrop, let us, get into, I would say, the topic of today's discussion, which is how bonds help in general in a financial portfolio. So I think the question Parth you asked over here was what are bonds effectively? I think because a lot of I would say investors and a lot of the people who have joined this webinar may have this question, which is very basic, as what exactly are bonds. So I think the first thing is a bond can be issued by a company or a government, and the government, if the central government issues a bond, we typically call it sovereign security, so which is like a GSEC, which is a government security, treasury bill, which is a short-term government security, and obviously recently sovereign gold bonds have become very famous. They are also issued by the RBI. So there are three. So government are issuers in all these three cases. And then if a company is issuing a bond, then it's typically called a corporate bond. A state government issuing a bond is called a state development loan, right? So these are typically the name that we hear. In all cases, the company or the government or the state government, they effectively need money which they want to raise by issuing a bond. Now they can need the money for various purposes. So the first thing is they need money. They're issuing a bond from investors because they need that money. If the investors think that the company or the government is a good quality counterparty and the return that they are showcasing at the time of issuance is worthwhile the risk, then the investors can choose to invest or buy in a bond. Now, once they have chosen to invest or buy the bond, then the company becomes the issuer of the bond. The investor is the subscriber. And effectively, it means that now the company or the government will make interest and principal repayments to the bondholders who are the investors over a period of time. So I think this same chart can be represented in the same way in a fixed deposit also, where the company or the government is replaced by a bank. So, for everyone, because we understand fixed deposit so well, so a fixed deposit is effectively an instrument where the bank is trying to is in need of money. So, investors are parking their money in a fixed deposit. And against that fixed deposit, the bank then pays you an interest and principal over a period of time, right? So a fixed deposit and a bond, they work same in the same way because they are both fixed income products, what we call. So if anyone who wants to understand what a bond is, it is exactly working like a fixed deposit, but rather than the bank issuing a fixed deposit, here the company or a government is issuing a bond. I think it's only technical nomenclature, it works in the same way.
I mean, that was really good insight into terms of understanding what a bond is, sort of. But could you also help us understand the risks associated with these bonds?
Yeah, so I think typically we talk about three risks, right? So first is a default risk because a company or let's say a government is issuing the bond. I would say there is nothing called as risk free. Now it's only a quantification of risk. So if a US government is issuing a bond, we might say that it is almost risk free. If even if India government, let's say, is raising a or issuing a bond, we can call it risk free. But let's say if a government of Zimbabwe or let's say Turkey is issuing a bond, do you call it risk free or how much is the risk associated, right? So even when government issues a bond, there's a risk. When companies issue a bond, there's a risk. So whether that's a Reliance, Tata, HDFC or a small company, risks are associated are different. So the default risk, what we call, is effectively the risk that the company or the government, which is basically the issuer of the bond, the risk of them shutting down, right? Or and if they shut down, they go bankrupt, or they do not have money to repay, then you will not get the interest or principal repayment that was due to you, right? And then so you are expecting some money to come to you, but you don't get that, right? That the risk is called default risk. The second is liquidity risk. Now typically what we advise and suggest all bond investors is to invest assuming that you don't need the money before the end of the tenure of that bond. So if you're investing in a 1 year, 2 year bond, we tell our investors that, and like, invest that money that you don't need for 1 year, invest that in a 1 year bond. If you don't need the money for 2 years, you can invest that in a 2 year bond. And why do we say this is because unlike fixed deposits, like fixed deposits you can break or you can redeem, in bonds you won't get that money before the scheduled repayment. Now the only way to get that money is if you are able to sell that bond to some other investor. Now, typically finding a buyer might be difficult, and this risk is called liquidity risk. So, if for whatever reason you need your capital, like you invest today and in 1 month suddenly you realize you have a need of capital, you may not be able to get that capital 1 month later because let's say the bond is a 12-month bond. In that case, so this is a risk. So you need to be aware of what the tenure of the bond is and invest that capital that you don't need for that kind of tenure. Because in India, in today's bond market, finding a buyer might be challenging, which is improving, but it might be challenging, and this risk is liquidity risk. The third is, I think, the most relevant one, which is reinvestment risk, which is you have invested, let's say, in a bond for 12% return. The point, and let's say the bond matures after 12 months. Now, the question is, after 12 months, will you find an opportunity to invest again at 12%? Right? So typically, sometimes we do get this choice very often that there is one bond which is giving me 12% return for a year, and a second bond which is giving me 12.5% return, let's say, for 2 years. Now, if I don't need money, right, you might want to invest in the 12.5% bond for 2 years because your reinvestment risk is lower. Because if you invest in a 12% bond for 1 year, you don't know that after 1 year, once you get your capital back, will you get another opportunity, right? So this risk is called reinvestment risk. Can you redeploy your money again at the same return threshold, right? So that's the typical risk, and I think everyone should be very aware of all these risks before at least understand what these risks are. Obviously, platform like us and will be there to handhold you to understand these risks and see if it can, whether you can make your investment decision easier after understanding that risk.
There was great insights into this, Saurabh. So while I was going through a few websites, especially a Jiraaf website, there are a lot of technical terminologies associated with the bond. If you could just help us understand those terminologies for a better understanding of what exactly a bond investment entails, I think that would give us a lot of insights.
So yeah, so typically, I think it's very crucial to first understand with these bond terminologies because sometimes when we go on the even let's say we go to a Jira website, we see a lot of data out there. But I think the question is that we might understand that what that data means, but how that data actually impacts my investment decision, I think is the more critical aspect. So this is a slide we put out, trying to make that simpler. So for example, rating, right? We understand that there's a triple B rated bond or a A minus rated bond, and so on and so forth. What does rating mean? Rating basically is a summarized, I would say, single output which showcases the financial health of the company, right? So because financial health of a company can be debated across multiple parameters, from growth to revenue to profitability, capability of repaying debt, sector risk, macroeconomic risk, many things are there. But if I need to summarize all of that and give it one particular output, that is what rating agencies do, and that is the rating. Now, why is rating important? Because it also, one, gives us the assessment of what is the financial health, and the second is it also helps us benchmark the price, because everything in this world is about risk and return, right? So one, the rating will help us understand or give an objective measure of risk, and the second thing is for us to look at is the return that I will get by investing in that bond, is that commensurate to risk. So in a very simple parlance, a minus rated bond should give a lower return than a triple B rated bond, because the risk in a minus rated bond is lower, right? So I think that's the way to think about it. Now, what are the nuances? Now, let's say we understand that triple B rated, what risk it is, and all of that. I think the more critical nuance to understand is what is the outlook then, whether the rating agency has given this a positive, stable, or negative outlook. And why this nuance is important is because it will also tell you over the next 1 to 2 year of your investment, what is the outlook on the company. So if it's a positive outlook, you will typically say that it is lower risk for, let's say, triple B rated positive outlook is lower risk than triple B rated stable, because in the positive outlook you are expecting that some financial health of the company is improving or is expected to improve over the next 1 2 years. Right now, I think the what should we be careful about is more important. That let's say there's a rating and a negative outlook, it means that, and let's say it's a 2 year paper, then it means that there is a potential that the rating downgrade might happen during the time of my investment. Now, how does it impact me? Obviously, for me, it is to say, think about risk as such. So, a triple A rated with negative outlook means that it might go to double A plus. So, default risk might anyway be low. But the question is that if that risk exists, then am I getting the right return? So, maybe benchmarking a triple A rated, neutral outlook versus a triple A rated negative outlook, I should get a higher yield on a negative outlook, right? And if for people who are more savvy and nuanced, you can actually also go into the documents to see that whether a rating downgrade increases my yield or not. Some companies and some issuances have it that if there's a rating downgrade, they'll pay out a higher yield or a higher interest, right? So now these are some of the nuances that you can think about, but rating largely tells you the financial health. For investors, it also helps us benchmark the price, and then the other nuances are which are where it comes into a decision making factor, right? The second is coupon and yield. I think a lot of people are generally confused on coupon and yield. So it's very simple. So coupon is basically will tell you how much interest that you make. So if a bond has a 100 rupee face value is nothing but similar to principal outstanding in some sense in a loan parlance. So if there's a 100 rupee face value and a 10% coupon, that means that the interest that you will get paid out in your cash flows is 10 rupees. Now, yield has nothing to do with coupon, because yield means that if you hold the bond till maturity, what likely return you can make. So let's say a 10% coupon bond can also be 9% yield, or it can be 11% yield. Now, why this yield differs is because basis, let's say I've made an investment today, and for 3 years, the financial health of the company is not same for the next 3 years. The macroeconomic is not same. The sectoral, I would say the way the sector behaves is not same. So the risk will always be increasing or decreasing over a period of time. Now that reflects in the yield, right? If RBI reduces rate, that will reflect in the yield. So the yield is a determinant of the market condition, the financial health of the company as on that date. Typically, coupon is determined at the time of issuance. So the yield will keep varying with the market over a period of time. And hence, for an investor, yield is most important because it means that if I invest in a 11% yield bond today, and if I hold it to maturity, I will make 11% return. I think that is the single line, and given everything else, I think that is what is the most important thing. What is the yield or the return I will make if I hold the bond to maturity? Right? Today we are not so savvy as investors to trade on bond or do bond trading and all of these things, right? So for us, it is just what is the yield if I hold to maturity. That's the simple, I would say characteristic or metric we should look at. Now, what are the nuances? So typically, coupon is if let's say in this example, if the coupon is more than yield, that means the coupon is 10%, but the yield is 9%. That means the bond was sold at a premium. Now, why was it sold at a premium? Because they are saying now that let's say the financial health of the company is improved. Let's say 1 year later there is a rating upgrade. So instead of the bond trading at 10%, they say it trades at 9%. So that means the bond has the financial health of the company is improved, and hence someone is selling the bond at premium. Now, if the coupon is less than yield, then the bond is sold at a discount. Now, what does this mean and why should we be careful about it? I think it's just important to know that if it is trading at a premium or discount, then why is it so? So typically, let's say, and I'll use a very recent example. People might know that RBI had a, for example, a direction on Navi where they said you can't do, I would say, fresh disbursal on notes. Now, this is an immediate impact in the market. While there is no, I would say, credit risk or default risk, but in general, there has been some negative news about this company. So it is possible that some investors might find it discomforting to be invested in Navi, and they might want to sell it at a discount. Now, the fact that the bond is trading at a discount, you might want to check that why is it trading at a discount, and there might be some news associated with it. So I think it's just these kind of things to understand that what market has complete information. So if it is trading at a premium or a discount, there will be some reason associated with it. Do I know the reason? Right? And if it is a marginal discount like 0.2 0.3%, those are just fluctuations. I don't think that really is critical. I think the third and more important thing is accrued interest. Typically we don't like, you will see that there are two components of any, or three components of a bond price. So, there is face value, which is like the principal. The second is accrued interest, which is typically, what was since the last interest paid out date, how much interest has now been incurred. So I'll use an example. Let's say we are sitting in 23rd October. So, the last interest paid out day, let's say, of a bond was 30th September. Now, as of today, the bond now has accrued 23 days of interest, and the next payment is on 31st October. Now, if I sell the bond today, then this 23 days of interest will actually go into the bank account of the bond buyer. So whoever buy, let's say Parth, you buy this bond from me, on 31st, you will get the entire 31 day of interest because on that day, you're the bond holder. Now, but I had the bond with me for 23 days. So when I sell it to you, I will say that, hey, you give me the face value plus the interest of 23 days, which you will eventually earn, on 31st October when the company pays that interest out. Now, this thing is called accrued interest, and to, basically give benefit to people that they earn for the period that they are holding the bond. Now, what are the nuance in this? Because the company on 31st October Path will pay out entire 31 day of interest, and the TDS will be deducted in your name, two things happen. One, the income statement will show that you have earned 31 days of interest, whereas you bought the bond only on 23rd October. So you have really earned 8 days of interest. But as per your income statement, it will seem that you have earned 31 day of interest. And the second is when the company pays you deducting TDS, the 10% TDS will be deducted on the entire 31 day of interest. Now, do I actually incur a loss, or do you actually incur a loss? The answer is no. It's just that when you file your taxes, you need to ensure, or your CA needs to ensure that you report your income as 31 days of interest, which is shown in your 26 AS or annual income statement, and cost of investment, and subtract the accrued interest portion that you have paid while purchasing the bond. So you will eventually pay income only on 8 days, but this is a nuance that you'll have to think of and take care of while filing the tax. The second minor point is, to the extent of the TDS, you will lose 10% on 23 days of the accrued interest portion. That 10% is a cash flow loss. So anyway, you will invest basis the yield, which you will earn over the period of time. But from a cash flow loss, a higher TDS was deducted today. Right. So I think these are the 2 points. And, for people, if there is some lack of clarity, we are always happy to have, these discussions, post the call or in the Q&A as well. Then the repayment schedule. I think typically before investing in a bond, everyone should 100% check what the repayment schedule of the bond is. Because just saying that the bond, this is a 2-year bond, 3-year bond, 1-year bond, is not enough. Every bond has its own schedule of interest and principal repayment. So that 100% everyone should check. Why is it important? And the nuance is exactly like the tenor of the bond might not be reflective of the payout schedule. And what we mean is, sometimes let's say we invest in a 1-year bond, but bulk of the payout is in the next 6 months. So let's say 80% of the payout is happening in the next 6 months, and then only 20% happening in the month 7 to month 12, right? And or it can be vice versa. So, or it can be staggered over the period of time, right? So the point is that the tenor of the bond does not reflect how you will get your money back. And so hence knowing the repayment schedule is important. And what should we be careful about? As we said, that liquidity risk is there, reinvestment risk is there. So if I'm getting money like very quickly, I might want to plan how do I reinvest that money. So first I should know that I will get the money quickly and then plan for the reinvestment. Or second is, how do I plan for my own liquidity, right? So I know that I don't need capital, let's say for the next 6 months. What is the point of investing in a bond which gives out bulk of the repayments in the next 6 months, right? So I think planning for reinvestment, planning for liquidity is critical, and hence knowing the repayment schedule is very, very important. The last is understanding the terms senior and secured. You will see it on the Jiraaf website. You will see it in many places that this bond is senior, secured, and so on and so forth. So what does that mean? Right. So I think the first point is on security. So security just means that, or a secured bond means that this bond has some kind of specific asset as a security. Now that quality of that asset is also good to know. So whether this is a fixed asset, or this is in, for example, a lot of NBFCs are issuers of bond. In case of NBFCs, while we say it is senior and secured, the asset is actually the underlying loan that the NBFC themselves have given, right? Vis-a-vis, let's say in a manufacturing company, the underlying security or asset can be the fixed asset, which might be a plant, it might be equipment, and so on and so forth. So in case of a real estate bond, the fixed asset might be land, or the security might be land. So the nature of the fixed asset or security might be different. I think that is important to understand. And senior means that in case, in priority order of all the debt lenders, right? So every company borrows from 5, maybe many lenders or many banks, many institutions, and many investors. So if I'm a senior, if it is a senior bond, it means that we sit topmost in terms of priority. So it means if the company has to repay 1 rupee only, we will be the first people to get that 1 rupee. Now there might be 5 different lenders who are senior. Then it means that that 1 rupee will be distributed amongst 5 different people, right? So I think so that is important to understand, that is seniority. Now, why it is important to understand secured bond and senior bond? It gives us a fair understanding of the risk. Now, what should we be careful about? Again, look at risk versus return. So let's say a Mahindra Finance is issuing a senior bond, and Mahindra Finance is also issuing a subservient bond. It can be a junior bond, it can be a subordinated bond. The pricing of the junior or subordinated bond should be higher, right? But if you don't know this nuance, you might get very happy that, oh, Mahindra Finance is issuing at a very good rate, but the actual nuance is that it is I would say, a junior bond or a subordinated bond, right? Or it is an unsecured bond. So every time measuring risk versus return is key, and hence understanding senior and the term secured is very, very important.
Thank you so much for that, Saurav. That was really, really helpful. Uh, Now that we understand what are bonds, what are the risks associated with bonds, the different terminologies which we spoke about, how should I think about my overall finances when it comes to bonds? Like we spoke about the personal finance bit in the start of the webinar, but just you
Yeah.
can just give us a little more insight.
Correct. So I think few things, right? So one is at this slide kind of shows that we design our financial portfolio into risk-free money and growth money. And in risk-free money, we spoke about how emergency fund and insurance, and maybe we just keep some additional buffer of liquidity, right? We might have some unplanned or I would say this unexpected expenses and so on and so forth. So that is my risk-free corpus. And what does risk-free corpus mean? It means that I can't take any risk on this money. And the idea of this money is not to earn returns or grow money more. The idea of this money is to give me safety. Now, if the idea of the money is to give me a more I would say a safe environment where I know that if I, let's say, don't have income for the next 6 months, I'm okay. In case of any event, there is an insurance. Any unplanned expenses, we have a buffer. So that's all I would say goes into this risk-free corpus, that we should always invest in very, very safe assets, because we cannot deal with, I would say, any uncertainty on this corpus. It's okay to not earn income, but we should not lose this capital. So that's why investing it in FD, gold, government securities is the best. Now, depending on the need for liquidity, I would say you can choose the asset. So for example, FD obviously is the most liquid. Gold can be most liquid, but that's depending on your choice. Government securities is also liquid, but not everyone knows how to seek that liquidity. So if you like, that this is, I need money which I've kept aside as, let's say, emergency liquidity only if, let's say, I lose my job or something, or there's an uncalled expense. In those cases, which we don't, that's a low probability event, you can invest that in government securities, and you will be able to sell it if need arises, right? So I think that's the way to think about it. Now the second corpus comes to growth. Now once I've taken care of my risk-free corpus, I've paid for insurance, I have my emergency fund, then I want wealth creation. And in wealth creation also, you need to divide this into two, which is long term and I would say short or medium term. Now, I think more from a long-term perspective, I think two favorite, like, the two asset classes in India are equities and real estate. I think there are, I would say, equal lovers of both equity and real estate as an asset class, but they are great only for long-term, I would say, long-term financial goals or milestones. So if my goal is that, when I retire at 60, I should have so much of corpus, or, this is how, I am 30 years old and, let's say my daughter or son's education corpus, maybe when I'm 45, 50 will be required, right? So any goal which is more than 10 years is long term. These kind of goals, equity and real estate, work fantastically. And, equity, and why they are suitable for long term is because real estate is suitable because it's low liquidity. So, you will, and you can't invest for a short term. And equity is suitable because they're of volatility. So, I don't know in the next 3 years whether equities will make positive return, but I know that over the next 10, 15 years, it most likely will in a developing economy like India, right? So I think it's long term suitable. Then comes short term and medium term goals. So let's say if I want to buy a car 1 year down the line, I want to buy a house in 2 years, I want to go on some international vacation in 1 or 2 years. Now, I have, let's say, my son or daughter's immediate wedding, which I think will happen in the next 1, 2 years. Now, these are all, I would say, short to medium term goals. Now you cannot put this money in equities or real estate, because real estate, you don't know whether you'll be able to liquidate. Equities, you will not know in the next 1 year how the market will perform. And hence, if the market is down, you will basically then lose some capital in, by investing in equities, right? Now, if your financial goal is certain, then you rather invest this money in corporate bonds or in some higher fixed income product, because FDs, we know, on a post tax basis doesn't beat inflation. Now, since your financial goal is at least 1, 2 year away, that's a decent amount of time. So you rather earn that incremental 3, 4% return over the next 1, 2 years, because I know that I'll need the money then. So I know there is predictability. I'm earning higher returns, and that's how my overall financial portfolio takes care of my financial goals. So I think, to summarize, how much is my risk-free corpus, what is my growth corpus, in my growth corpus, how much do I need for my long-term objectives, how much do I need for short to medium-term objectives, and then allocate money accordingly. Having said everything, diversification in any financial portfolio is key. So that means that I would say that 100% exposure to any asset class obviously is a big risk. So you should invest in all asset classes. The quantum and percentage is determined by your own financial goals.
I think so that has really changed my perspective on understanding how should I invest my investable surplus at the end of the month. Thank you very much for that. Uh, if there's a situation where I have some money left, and would you suggest investing in a FD, or would you suggest investing in a bond of the same institution? If you could help us a little bit on that.
Yeah. So, I think that everyone in India has a lot of money in FDs, at least, especially, I would say, people who are maybe more from an older generation have more disproportionate money. I think the younger generations today more actively invest in equities. But in general, I would say, what we have seen that people understand short, medium term goals, still in a decent way, but all the short-term goals are met by an FD investment, right? So if I need my money back in 1 year, so people are like scared to invest in equity, so they make a 1 year FD. Now the point I'm trying to make is, over here is FD does not beat inflation on a post-tax basis. So real money you're actually losing. So you need to find a investment opportunity that beats inflation, at least on a post-tax basis. And second is, there are far better opportunities than AFD. And the first table top right, it basically shows the yields of government securities vis-a-vis fixed deposits, right? And the top bank fixed deposit. Now, why do we like fixed deposit? Because it is insured up to 5 lakhs. And we know that in 1 year we'll get the money back. Now you compare the yield of a SBI or HDFC fixed deposit vis-a-vis a T-bill. So in SBI and HDFC, the government insures only up to 5 lakhs. In T-bill or GSEC, your 100% amount is guaranteed by the government, right? So in fact, even if you invest 50 lakhs or 1 crore, the entire amount is government, I would say, guaranteed, vis-a-vis in a fixed deposit, which is only up to 5 lakhs. Now, in spite of that, if you see the T-bill returns are more than the returns of a SBI or a HDFC fixed deposit for every range or every tenure. Now, this is, I would say, just like a lot of investors don't have this market information and miss out on returns. So let's say you feel that any corporate bond is risky or you don't understand it. I would say the easiest investment is move your FD money to a GSEC or a T-bill. It will give you higher returns and also better security. So you're taking lower risk, earning better returns. That's the best of both worlds. Now, the second is comparing just fixed deposit vis-a-vis your bonds. Now, even T-bills on a post-tax basis may not be able to help you beat inflation, but a bond can do that, right? So we have, and I think when we create a fixed deposit, we typically don't understand the rating. So, for example, Utkarsh Small Finance Bank is actually A plus rated. So the fact that they are giving 8.5% on fixed deposit is great if you're investing only up to 5 lakhs. But if you're investing any amount more than 5 lakhs, then how do you should think about it, right? So we have compared similar rated banks with the similar rating of bonds. I think the risk is entirely the same. The additional benefit of fixed deposit in banks are obviously the government insurance. So, but keeping that in mind, you should think of the quantum you're trying to invest, and then hence which is a better investment product for you. Every bond, every rating of bond, commensurate rating of bond will give you a higher return than a fixed deposit. So, in general, that's why at the similar rating category, also bonds are better. And the second is obviously, you can, instead of investing in a HDFC bank fixed deposit, can you invest in a A plus or a A minus rated bond, which will give you, let's say, 11-12% return and hence beat inflation for you. So I think these are the few things that, even for the same risk, you can get higher return in a bond. And the thing is, you can take maybe incrementally higher risk because A minus, A rated papers in India also won't see default unless there is some, I would say, a very unexpected event. So do you push that return by 3-4% so that you beat inflation? I think the way to think about it over here is, if I invest in 10 different bonds consistently over 10 years, in an outlier situation, you might see, if you're unfortunate, you see one, let's say, some impact where some bond defaulted. In that 1 year, you will make probably 0%, 1%, 2% return. But then remaining 9 years, you will make, let's say, 10, 11, 12, 13% return, right? So that works with any other asset class. So in a good equity year, you will make, plus 40%. In a bad equity year, you will make minus 20, minus 30%. So I think the similar philosophy works even in, with bonds or any fixed income asset class. And that's the way to think about it.
Next time, definitely, I'll have a look at both the FD rates and the bond rates while investing at the end of the month.
Absolutely.
Thank you so much for that, Saurav. So, again, coming to the personal finance front, what is a bond investment offer that I usually don't get today? If you can just help us with that.
Yeah, so we spoke about all of them, but I'll just summarize it in one line. So I think one is, it offers stability and predictability. Now the use case is that if sometimes, let's say, we are professionals, so let's say a doctor or a lawyer, a freelancer, even if you have income, that income might be, I would say, variable, right? So you're not getting I would say, you're not getting the same amount of, like a salaried employee gets. You don't get the same I would say, income every month, right? Some month is higher, some month is lower. So in, like, if you are from this kind of a professional background, maybe investing in a bond is good, because to meet your monthly expense, you have made an investment and you make sure that I get my monthly cash flows to meet those expenses. And then basis your income, which can be up and down, you can invest the bulk corpus either in equity or bonds again, right? So you can plan your finances better. Second is retired individuals who don't have an income. Again, to meet their expenses, they can invest in a bond and ensure that their cash flows meet their monthly expenses, right? So I think stability, predictability is very important. The second is general diversification, because equity has a different kind of risk, so it's highly volatile. Last 3 days, we've seen equity markets has not done well, right? So if you are a person who takes, let's say, stress, likes, I would say, peace of mind, having at least, let's say, 30-40%, 50% maybe in fixed income or bonds will ensure that the variability in your portfolio is very small, so you're always sleeping well. There is a part of your portfolio which is giving you exactly 10, 11, 12% return. There is no variability to it. That gives peace of mind. So I think, and diversification is important. You can't put 100% capital in any asset class. So bonds is giving you diversity as well as predictability. And third is this ability of meeting short term and medium term goals. I think we don't plan our finances basis the financial goals or milestones that we have, which we can actively do. So for any big ticket expense or capital outlay, you can actually plan your finances by investing in a bond. So I think short term, medium term goals, diversification, and stability and predictability, I think all three are very unique to bonds and fixed income as an asset class. And I think that's why it's a must in everyone's portfolio.
All those reasons seem to be really compelling, to invest in bonds. But just the last question, Saurabh, how do I start investing in bonds?
Yeah. So I think the answer to that is very simple. You can log into Jiraaf.com. I think, I think we've kind of, the world of bonds can be very complex. There are, I would say 10,000 bonds out there. What we do is basically select, 5 to 10 different opportunities, so that you don't have to go through the remaining 9,000 or 9,900 of them. So you basically look at the 5-10 opportunities, understand all the terminologies, understand the risk, and see whether this sounds interesting to you. We have bonds starting with as low as 1,000 rupees, and in some cases 1 lakh. So depending, I would say that what I would you only learn to swim once you jump into the pool, right? So it's like you'll only understand this asset class better once you have made your first investment, and then understand all the nuances about it. So I would only request everyone to kind of try and make at least one investment, so you'll get a better understanding of the asset class itself.
Thank you so much, Saurabh, for all the information.
I would just say thank you to everyone for joining in on this webinar, and hope there was some positive takeaway and learning for everyone out there. So thank you so much. And as I said, please log into Jiraaf.com and do at least give a try at understanding the product, the asset class, and how you can invest in it. Yeah, thank you so much.
Thank you, everyone.